Hey guys, in this video we will see my approach for backtesting trading strategies. So first of all, why algorithmic trading and not discretional? Well, first, algorithmic trading can be exactly written as rules or parameters and reproduce accurately over historical data for statistical significance. Secondly, there is no psychology involved, so the execution is cleaner actually. And finally, it is scalable to multiple strategies, assets, and machines, so you can build a diversified portfolio. So when you define your trading strategy, you always start with your data, of course, which can be candle data, tick data, fundamental, news, or satellite. And you have two approaches. You can either define your set of rules, or you can have a machine learning model which can learn from the data and theoretically learn new patterns. And at the end, you will have buy and sell signals at each point in time. So usually people backtest their strategies using vectorized backtest. So how does it work? Let's suppose we are considering a window of 3 candles. In this case, we are examining candle patterns. And our algorithm tells us that we want to enter at this candle close here. Okay, so we mark this candle, which is candle T, with 1, which marks the entry. And we forward fill our entry signal until we find an exit signal. So for example, here we want to exit. So we place a 0 in our position or signal vector. And all the other points where we have no entry will be marked as not a number. Now all we have to do to calculate our strategy returns is to multiply our signal vector shifted by 1, because remember we are evaluating our signals at close of candle T. So in the real world we are entering at open price of candle T plus 1. Okay, so we shift our vector by 1 and we multiply by the candle returns vector to obtain the strategy returns vector. Well, this is good for some points, such that it's very fast and efficient, of course. Can include capital compounding, because if we use log returns, we can just sum them and we have the cumulative return. And also can include variable size if we include an external vector with a fraction capital we are using for each position. It has two problems. First, it can't account for stop loss and take profit levels, because of course, if we're entering here and we would have placed a take profit at this price here, this candle close up, so we're not effectively taking into account this kind of situations, and especially with stop loss levels, which are much more important. And also it can't include commissions related to capital, because as we loop through every candle, our capital is changing, and that depends the actual commissions we are paying over time. So my current approach for backtesting strategies is to actually loop through each candle. I personally use 5 separate vectors, one long and one short, for identifying entry and exits. In this convention, 1 is for entry and -1 is for exit. Then I have a vector for take profit and stop loss prices. So when I have an enter, I also can set my take profit and stop loss. And finally, the size, which is the capital fraction used for that particular position, which is very useful, for example, when I have to manage my risk. For example, I set my stop loss level and I want to lose, for example, 1% of capital if I lose a trade. So I will calculate the fraction of balance I have to use for that position. The backtesting algorithm looks like this. So as I said, I loop through each candle and I evaluate my positions over 2 moments, which are the open and close of the candle. So first of all, I look if I have any open position. If I do, I increase my equity by the gap return, defined by the current open minus the previous close. Then if I have any close signal, I close the position. After that, I look if I have any open signal and I am not in an open position, and I open a new position. Okay. And finally, at the close, I check if I have any open position, and if any take profit or stop loss level is crossed, I increase my equity by the return defined by the take profit or stop loss level minus the open of the candle. If not, I just increase it by the body return. So one thing I didn't mention before is that you always have to include commissions in your backtest, because even a very profitable strategy, if you add a little bit of trade fees and maybe a swap, it can totally lose its performance. So this is very important. There are four kinds of commissions. There are trade fees, which are paid every time you make a transaction and can be fixed upon your trading volume or value traded. Then you have swap, which is paid every day that you hold a position overnight, and it's usually tripled during weekend. Then you have spread, which is the difference between ask and bid prices. That impacts, of course, your execution price. And finally, you have your slippage, which can be positive or negative, but it's a good idea to include it. I prepared a demo strategy to show you. In this case, we will see a moving average crossover. So this strategy has four parameters: these low and fast periods of 50 and 20 by default. And these are just ranges I use for optimization. Then it has an ATR multiplier for defining a stop loss level, and a risk per trade, which is the percentage of capital I want to risk for each trade. So we import the data frame with candle data, calculate slow and fast moving averages, and define the cross up and down condition as follow. So the cross up is when the current candle fast moving averages is above the slow, while in the previous one it was below. And the cross down is exactly the opposite. So we define the entry and exit vectors I showed you before. So in this case, we have two separate vectors for entry long and entry short, so you can understand better. But basically, we entry long when we have a cross up, and we entry short when we have a cross down. And the exits are just the opposite of the entries. We have no take profit, and we set a stop loss at the low price of the current candle minus the ATR multiplied by a factor for long positions, and the high plus an ATR multiplied a factor for short positions. Then we calculate the size of capital I need in order to risk a certain amount for this stop loss level, and that's it. So this is the software I use for backtesting strategies. I built it myself using Python and the PySide 6 library. So I'm gonna download the data for Apple between 2020 to 2026. So here I can see the close price. Here I can see the preview of the data frame, and here I have some data quality reports. So I'm gonna load my strategy. And first of all, I want to validate my signals. So I'm gonna look into where my strategy tells us to enter. So here we can see that the fast moving average is crossing above the slow. And indeed, we have a long entry signal and also a short exit signal, because we have set both during the same event, okay, which is the cross up. Later, we can see also this is a very good trade. Then when the moving average crosses below, there is a short entry and long exit. So we can also see the date, which is 30 of April. So as you can see, on the 30 of April, we have a long entry signal with an exit short also signal and a stop loss level of 65, which is this one. So the signal is actually computed correctly, so we will proceed with the backtest here. So I start with a capital of $100,000 and I don't set any commission for now. Okay, so we can see the strategy is basically worthless as I expected. It has a Sharpe ratio of 0.2 and has performed 30 trades in 6 years. So it's basically 5 trades per year, which is very low. But here we can see in general the monthly return as a percentage, the equity, the histogram of daily returns. So if you have an intraday strategy, it will sum all of the returns over that day. And also we can see the drawdown and the distribution of drawdowns. Another thing we can do is actually to check those trades. So here we have a data frame with all the entries and exits actually performed. So for example, here we have our first signal of long entry, which exits right here. So the first one was the very good trade of 46% over that capital fraction, which is very good. But later we can see that the strategy loses some money. So here we have a short trade which exits here. Then we have a long one which exits here, and so on, basically. So that's it for this video. In the next one, we will see how to actually optimize the strategy and stress test it to understand if it's robust enough to go live in production. If you liked this video, please leave a like and comment and let me know what you think. See you in the next one.